Welcome to the deep dive. We're here to take these pretty dense Q3 2025 earnings materials from a major insights company and, well, pull out what you really need to know.
Exactly. Our job isn't just reading numbers off a page. We want to get behind those headline figures. Understand what's really driving the business, the big strategic moves they're making, and what that might mean down the line.
Okay, let's jump right in then. The big picture number they reported was what, $1,170 million in revenue. That's 8% growth year over year. Seems decent.
It does seem decent, but that 8% is actually hiding the better story.
Hiding it how?
Because last year's comparison includes this huge one-off breach remediation contract they won.
Right.
It inflated the baseline. So if you look at the organic constant currency growth, the OCC figure.
Right, the OCC. That strips out currency effects and these kind of one-time things.
Exactly. It gives you a cleaner view of the core business. And that number, the OCC growth, was actually 11%.
Okay, 11%. That's quite a bit stronger.
It's significantly stronger. It tells you the underlying momentum is really accelerating, maybe the strongest since, 2021, I think the material said. The core engine is humming.
All right, so 11% underlying growth. That sounds pretty broad-based. Where's that coming from specifically? Which parts of the business are really pulling the weight?
It is definitely diversified. But the U.S. market segment, that was a real highlight. Overall, U.S. revenue grew 7%.
Okay.
But again, pull out that comparison effect from last year's big win, and the real underlying growth in the U.S. was 13%.
13% in the U.S. Wow. Okay. Break that down a bit more. What about financial services within the U.S.? That's usually a big driver.
It certainly was this quarter. Financial services saw really significant acceleration. We're talking 19% OCC growth.
19%. That's huge.
It is. And even if you strip out the mortgage part of that, which can be volatile, it was still up 12%. So really strong demand there.
Is that just banks playing catch-up on tech spending, or is it something more sustainable, do you think?
Well, the sources suggest it's a bit of both, but leaning towards sustainable demand for their newer advanced analytics products. You see it clearly in the mortgage segment, actually.
Oh, yeah. How so?
Mortgage revenue was up 35%. 35. Even though the overall number of mortgage inquiries in the market was basically flat.
Right, so they're selling more value, higher price stuff into each transaction, even if volume isn't booming.
Precisely. It shows their pricing power and that lenders are adopting their new innovations quickly, even in a tough market.
Interesting. Okay, what about the other U.S. segments, emerging verticals?
Yeah, emerging verticals, that's things like insurance, utilities, non-lending stuff that grew 7.5%. And the company noted that's the best growth they've seen in that segment since 2022.
So the diversification push is paying off there.
Seems like it's starting to mature nicely, yeah.
And we should probably touch on consumer interactive. That number looked, well, pretty bad on the surface, right? A big decline.
It did look bad, down 18%. But that's almost entirely that comparison issue we mentioned, comparing against last year's massive breach remediation revenue.
Ah, okay. So if you adjust for that.
Adjust for that, and it was actually up mid-single digits. So, basically stable performance underneath that noise.
Got it. Okay, let's shift overseas. International. How do those markets hold up? Often a bit more choppy.
International was actually very solid, delivered 6% OCC growth overall.
And where was the strength there?
Pretty consistent performance. The UK was up 11%, Canada also 11%, and Africa posted 12% growth. Really strong showings.
And India. That's a market everyone watches.
India grew 5%, which, considering some local tariff issues tempering lending volumes, is pretty good. They said it was driven by new business wins and innovation sort of outpacing those market headwinds.
So strong execution there, basically winning share and pushing new products.
Exactly.
Okay, that paints a picture of pretty resilient growth across the board. But you mentioned innovation and new products. That leads us to the tech side, this big OneTru platform migration. How's that going?
Yeah, the OneTru program. This is really the foundation for a lot of what we're talking about. It's their huge multi-year project to unify all their data and systems onto one modern platform.
And what progress did they actually make in Q3? Are they hitting milestones?
They did hit a key one. They completed the migration of their first set of customers onto OneTru, and importantly, they highlighted that these customers are already seeing benefits, faster processing, quicker access to new tools like their TruIQ analytics.
Okay, so early positive feedback, but it's a massive undertaking. Are they still on track for the big deadlines, mid-2026 completion, wasn't it?
That's the plan. Still aiming for mid-2026 for all U.S. credit migrations. The next big step is hitting critical mass of those migrations by the end of 2025.
And how are they making sure that goes smoothly? Moving major clients is risky.
They specifically mentioned expanding dual runs with their largest customers, so running the old and new systems in parallel for a while to iron out kinks before the final switch. Seems prudent.
Right, okay. And the payoff. What are the hard financial benefits once this is done? The cost savings and efficiency gains.
Well, there are two big pieces. First, they expect to deliver the last $35 million slice of planned operating expense savings in 2026.
Okay, $35 million OPEX.
But maybe more structurally important, this whole transformation lets them significantly lower their ongoing capital spending. They're targeting CapEx to be just 6% of revenue in 2026.
6%. Down from what? Much higher levels during the build-out?
Oh yes, significantly higher. Bringing CapEx down to 6% structurally is a major lever for expanding margins going forward. It means the big investment phase is ending.
That's the real signal, isn't it? Less cash going into building the pipes, more flowing through them.
Exactly. More free cash flow, which we'll definitely circle back to when we talk capital allocation.
Good point. Now, you mentioned new tools like TruIQ. How does OneTru connect to, well, the other big buzzword, AI?
It's completely connected. OneTru is basically the launch pad for their AI initiatives. They're using AI internally, tools like OneTru Assist for their developers, OneTru AI Studio for non-coders, to build things faster on the new platform.
Okay, internal efficiency.
And then externally, they're delivering AI-powered solutions to clients through OneTru. Things like the TruIQ analytics we mentioned, advanced fraud detection tools.
So the platform enables both building AI and deploying it to customers more easily.
Precisely. And their core belief, which they stated pretty clearly, is that AI-empowered customers use more data and can adopt our newest innovations faster. It feeds itself.
A virtuous cycle, they hope. Okay, let's pivot again. We touched on that strong 35% growth in mortgage revenue despite flat inquiries. This feels like a good time to dig into their big strategic play there. VantageScore 4.0.
Yes, this is a huge part of the story right now. It's a major competitive push. First off, the big news is that VantageScore 4.0 is now fully approved for use in mortgages backed by Fannie Mae, Freddie Mac, and the VA.
Which is massive. That puts it on par with, well, the dominant player, FICO, in terms of acceptance for a huge chunk of the market.
Exactly. It levels the playing field in a way it wasn't before, and they are leaning into that opening with a very, very aggressive pricing strategy.
Aggressive how? What are we talking about?
They've priced VantageScore 4.0 at $4 per score. $4.
Okay. And the context.
The context is that the main competitor, FICO, just announced a price hike, doubling your price to $10 per score.
Wow. So $4 versus $10. That's basically declaring a price war.
It absolutely is.
Yeah.
And to sweeten the deal even more, they're offering VantageScore 4.0 for free for evaluation purposes through 2026 to any lender who buys a FICO score. They're saying try ours side by side at no risk.
That's bold, clearly betting that lower price, and maybe the tech itself will win lenders over long term, even if it costs them margin up front.
That seems to be the bet. But it's not just price. VantageScore 4.0 also uses different data inputs that they argue are more inclusive.
Like what kind of data?
It uses trended credit data, looking at payment patterns over 30 months, not just a snapshot. And it incorporates alternative data, things like rent and utility payment history.
Which means it can score people who might not have traditional credit files, right? The credit invisibles.
Exactly. And the potential scale of that is kind of mind-blowing. They estimate VantageScore 4.0 could help score something like 33 million consumers who are currently unscorable by older models.
33 million. And what does that translate to in market opportunity?
Potential impact they cited is unlocking around $1 trillion with a T in additional mortgage lending opportunity. That represents maybe 2.7 million more mortgage loans.
So it's a play for market share against FICO and a play to actually expand the entire market through financial inclusion?
That's the strategy. Two birds, one stone.
Okay, let's connect this back to the financials. If mortgage volumes eventually recover from today's pretty depressed levels, what's the upside leverage here?
The leverage is significant, especially now with the more efficient OneTru platform processing things. Their estimate is that every 10% increase in mortgage volumes adds about $40 million to adjusted EBITDA.
$40 million for every 10% volume lift.
About $0.15 to adjusted diluted EPS.
Okay. And what if we saw a full recovery, say, back to 2019 levels?
If volumes got all the way back to 2019 levels, that could translate to an additional $240 million in adjusted EBITDA and 0.90 cents in adjusted diluted EPS.
90 cents per share. That's a huge amount of latent earnings power just sitting there waiting for interest rates to eventually turn.
It really is. It highlights how much operating leverage they have to a mortgage market recovery, amplified by the VantageScore strategy.
Let's wrap this up by looking at the overall financial outlook and how they're using their cash. Given the Q3 beat and that 11% underlying growth, they raised their full-year guidance.
They did. They bumped up the full-year guidance for adjusted diluted EPS. The new range is $4.19 to $4.25 per share. That's 7% to 9% growth for the year.
Okay.
And they also nudged up the full-year revenue guidance to reflect that 8% OCC growth expectation.
And the balance sheet getting stronger. You mentioned leverage earlier.
Yeah, they're continuing to delever naturally. The net leverage ratio was 2.7 times trailing EBITDA in Q3. They expect that to tick down to 2.6 times by year-end, even before factoring in a planned acquisition in Mexico. So pretty healthy.
And the free cash flow conversion, you said that was key with OneTru finishing up?
Right. This is a big part of the story for 26 and beyond. They expect free cash flow conversion, how much profit turns into actual cash, to jump from around 70% this year, 2025,
Which is okay, but not great.
to over 90% in 2026.
90% plus. That's a massive improvement. Means way less cash tied up internally, right?
Exactly. It signifies the end of the heavy investment cycle for the transformation. That cash becomes available for other things, like returning it to shareholders.
Speaking of which, what are they doing on that front? Buybacks. Dividends.
Very focused on buybacks. They repurchased about $160 million of stock just in Q3 and October combined, around $200 million year to date.
Okay, pretty active.
And the board really underscored that commitment. They just increased the total share repurchase authorization up to $1 billion.
$1 billion. That's a statement.
It is. They explicitly called repurchases a highly attractive use of capital right now. It signals strong confidence in future cash flows and, frankly, that they think their stock is undervalued given everything we've discussed.
Okay, so let's try and pull all these threads together. We've got stronger than headline underlying growth, right? That 11% OCC, driven by financial services, solid international performance.
Check. And that's built on the back of this massive OneTru tech modernization, which is nearing completion, set to deliver cost savings, lower CapEx, and better free cash flow.
While also enabling their AI strategy, getting those tools out faster.
Right. And then layered on top is this aggressive, really fascinating strategic push into mortgage with VantageScore 4.0 using price and technology to challenge the incumbent and potentially expand the whole market.
With huge potential earnings leverage if or when the mortgage market turns around.
Exactly.
So maybe the final thought to leave you with is this. We saw VantageScore adoption outside of mortgage grew, what was it, 55% last year. It's clearly gaining traction elsewhere. Now, with the massive price gap versus FICO and full agency approval in mortgage, how fast will that adoption accelerate in the mortgage industry itself?
And maybe more importantly, what happens when you suddenly make 33 million more people visible to the lending market? What does that do for financial access, for market stability, for growth long term? It's a really interesting dynamic playing out.
Definitely something to watch. Okay, you are now thoroughly informed on this deep dive. Thanks for joining us.